Hi, I'm Hannah, a Director in Deloitte's Business Services M&A Advisory team, and I'm here to tell you about our 2023 M&A outlook for business services. We've seen post-pandemic deal activity reach an all-time high in 2021, which continued into H1 this year. With the increasing market uncertainty, there was close to a 30% drop in Q3 based on the same period last year, which we're continuing to see into Q4. Initially, this may seem significant, but not when you consider the heights it's dropped from. It's still healthy compared to previous levels. And whilst investors are taking time to evaluate assets, overall 2022 is expected to have seen one of the highest levels of M&A activities in the last decade. So what's driving market activity? Businesses with an ESG angle continue to demand a premium, and COP27 is focusing attention on sustainability once again. Education services are also in the limelight due to continued reporting about attainment gaps, especially those supporting disadvantaged children, as demand increases with rising cost of living. Rising interest rates and market volatility have led investors to focus on quality assets, and we are seeing closer scrutiny of key metrics driven by their need for cash flow security and revenue visibility. This has led more attention towards, firstly, administration services, such as pensions, offshore trust services and fund admin services, as all provide long-term revenue visibility and market growth, thanks to structural and regulatory changes. Secondly, tech-enabled services across the education, HR and legal sectors offer subscription-based revenue streams and potentially higher margins. Finally, essential infrastructure services like connectivity solutions have consistent demand and contracted revenues. Something that is continuing to gain more attention from international investors is UK assets with material global footprints, and this is helped by our weak currency. With less leverage, principals and advisors must be more creative when bridging funding gaps and valuation expectations. This gap is the most material change when executing deals in the current environment, as the appetite to transact from both buyers and sellers remains. Investors may have a lot of capital, but they're taking their time deploying it. Therefore, early conversations with investors that build relationships over an extended period play an increasingly important part in securing M&A transactions. Now, let's look to 2023. Next year, we anticipate more trade deals, including PE-backed trade doing bolt-ons and corporate tidy-ups. And the flight to quality will continue for investors. The risk of capital gains tax rising, as highlighted by the Office of Tax Simplification, could motivate owners to sell sooner. As suggested by current polling, the likelihood of a Labour government at the next election is also expected to encourage sellers. Finally, recessionary environments typically generate pricing pressures, but this will be partially offset by investors having a clearer view of the underlying profitability of assets post-COVID. Strong pricing will be maintained for those high-quality, resilient assets. Please do get in touch to find out how the current market could impact your organisation's 2023 M&A agenda.